Hello and welcome to the Woodman Outlook for the fourth quarter 2022. I'll start with the macro picture, which remains preoccupying. Estimates for global growth have been revised down sharply throughout this year, and 2023 estimates are also revised down. The policy mix, fiscal and monetary policy, is a headwind for the global economy. On the plus side, job markets are generally strong, but let us not forget that job markets are a lagging and not a leading indicator of economic activity. Inflation has surprised on the upside in the US, in the UK, and in the Eurozone throughout this year. We would expect that base effects mean that the level of inflation is likely to diminish somewhat, but is going to remain well above the targets set by central banks. China and Japan have generally less inflationary pressure than in the West, and that has implications, obviously, for how their central banks will react. I'll turn now to monetary policy. In the US, the Federal Reserve has made it abundantly clear that they will continue to tighten policy through higher rates and a reduction in their balance sheet until such time as inflation is coming back down towards their 2% target. That will take much longer and take higher rates than currently anticipated by the market. The European Central Bank faces a similar dynamic, with inflation currently running at 10% year on year, but the ECB has tightened less than the Fed in the United States and will need to do more. The ECB is behind the curve. In Asia, China does not face the same inflationary pressures as in the West, and with the economy slowing, we expect the People's Bank of China to ease policy over the next 6 months. But all in all, the monetary policy framework is likely to remain more restrictive for longer than currently anticipated by investors. This environment of sluggish economies and uncomfortably high inflation is negative for fixed income markets, which already have lost over 20% since the start of 2022. In the US, 10-year Treasury yields are still below 4%, but with the Fed continuing to tighten and inflation still high, we expect yields to move above that level over the next few months. In the Eurozone, the ECB, as mentioned, is behind the curve. Rates have moved from negative to positive territory for 10-year German Bunds, but at around 2.3%, there is still more upside for longer-dated Eurozone government bond yields. In terms of credit, the environment is unfavorable, with weakening economies putting downward pressure on the health of corporate balance sheets. Finally, for emerging market bonds, we still see some value in Chinese government bonds, where yields are higher than inflation, so positive real yields. But the trend in the Chinese currency, the renminbi against the dollar, is negative, which removes some of the attraction of diversifying into Chinese government bonds. We do see, finally, some opportunities emerging in shorter dated bonds, which are less sensitive to moves in interest rates. Specifically, 2-year Treasury bonds offer an attractive yield today, as do high-quality corporate bonds in euros. Now let's turn to currencies and commodities. This year has been a story of dollar strength, with the dollar index up over 17% since the start of the year. Further upside beckons, in particular if recent highs are broken. The dollar is reacting to higher interest rates in dollars than other currencies, and also a shortage of dollars in the global financial system. And the strength of the dollar is posing problems for borrowers in dollars and for importers who need dollars to pay for the goods they've purchased. We would expect at the G20 summit in Bali next month in November for there to be an active discussion as to what should be done about dollar strength. In terms of commodities, with the global economy slowing, demand has weakened somewhat for energy and industrial metals, and prices have come down. But underinvestment in productive capacity in recent years means that the longer-term outlook, both for energy and industrial metals, remains positive. And finally, gold, which we continue to hold in client portfolios. Gold is an excellent diversification instrument compared with other asset classes. Like bond markets, equities have had a very difficult 2022, with prices down over 20% since the start of the year. The reasons are clear. Economic weakness, higher rates, and tightening monetary policy putting downward pressure on valuations. However, earnings expectations have held up so far, and we expect those to begin to decline as analysts adjust their forecasts to take into account the weaker macroeconomic backdrop we've discussed. We recommend a strong underweight allocation to equity markets, and within that, we would focus on some opportunities in areas like Swiss equities, which have great defensive characteristics, Japan, which offers diversification benefits, and value stocks, which tend to outperform growth stocks in times of rising bond yields. And let's wrap up with our key convictions for the fourth quarter 2022. First and most importantly, the message to investors is to stay defensive. This is not a time for taking undue risk in either fixed income or equity markets. Indeed, we are underweight fixed income markets and underweight strongly equity markets. Within fixed income, we see some opportunities emerging in short-dated US Treasuries and short-dated euro-denominated corporate bonds. They offer a more attractive yield than is available on cash and a short life until they finally mature. In terms of equity markets, we highlight the attractions of Switzerland, which is defensive, Japan, which offers diversification benefits, and value stocks, which tend to outperform growth stocks in times of rising bond yields. In terms of currencies, the path of least resistance for the US dollar remains upwards, and we'll watch with interest what the G20 in Bali has to say about the problems posed to the global economy by dollar strength. We're neutral on commodities, given the sluggish macro backdrop, but we highlight the fact that the longer-term picture remains positive, both for industrial metals and for energy. And finally, we're overweight cash and alternative investments, which provide uncorrelated sources of returns in portfolios. But the bottom line is, as said at the outset, stay defensive.